I read a report the other day where in Ontario they're saying that insolvency is going up, and I think it's about 2 to 2.5% in 2025. What are your thoughts on that? And if I'm getting the numbers right, do you see any concerns? Are we heading down a path where you might think that we could be getting into something more difficult in the next couple of years?
Yeah,
Awesome. All right, we are live. Wes, how are you doing, my friend?
I am good, sir. How about yourself?
I'm great. I'm great. This is the third time that we're doing this. Super excited to have you here. I want to touch on quite a few different topics today with you. We've seen what's been happening in the marketplace, and I want to dive into. We'll kind of maybe cut this up into two shows. So I think the first show I want to touch on understanding debt and the different options that people do have, maybe in the situation that they're in. And then we'll dive into maybe some of the risks that you're seeing out there in the marketplace, some of the big trends that you're seeing, and maybe like a bigger picture of where you think maybe the market is going. I think you're the right person for this. So, um, you know, why don't you jump in and just let everybody know who MNP is, who Wes is, and you've got this or not early retirement, you got a retirement coming up. I won't say early retirement. I don't know. Is it early or is it late?
Well, I guess it depends on your perspective. I don't know, but yeah, in a couple of months anyway, or transitioning to a different kind of work anyway. It's never completely retirement. It's more a matter of just moving to something a bit different and some other things that I'd like to do with my time. But yeah, I mean, I've been working with MNP now for well, going on almost 16 years. MNP is at this point the largest solely Canadian-owned accounting firm in the country. And as part of those services, in addition to all the usual accounting things you'd think about, tax services, audit, all those kinds of things, and a whole range of other services that people might be interested to know that we do, we also have insolvency or debt help services, where licensed insolvency trustees like myself help people who find themselves in a lot of debt and need to find a way to get some relief from that. We talk to people every day on these things, and we do see trends that are happening in the economy, and over the past few years, kind of seeing what some of the changes are there. And we certainly have been busy of late. So yeah, I'm happy to talk about any of that kind of stuff, and yeah, go from there.
All right. So why don't we touch on that you're saying that you've been busy of late? And is there a larger trend that is happening, specifically over the last couple of years, now that interest rates have kind of gotten back to some, what we'll say of a normal rate as opposed to where we were at the peak?
Yeah, for sure. I mean, I think it's sort of these things are always a bit of a lagging indicator sometimes. Like you have an impact, a shock to the economy, and then it takes a while for that to sort of play through. And so we're seeing, I think, now the effect of just really not everybody. There's still some pandemic effect going on out there in terms of the amount of debt that people were carrying. Sometimes that's gotten magnified, and part of the reason it's gotten magnified is because we've seen inflation go up a lot. For a while, we had higher interest rates. Yes, they've fallen back, but they haven't fallen back to sort of pre-pandemic or pandemic levels. And so as a result of that, there's additional strain on people's finances. And a lot of times people's incomes haven't kept pace. We haven't seen incomes go up, for example, at the same rate as grocery costs have gone up or whatever. So you have all those impacts, those pressures on people, and they're still carrying debt, so they have to service that debt as well. And in some cases, people have actually taken on more debt in order to compensate for the amount of income that they haven't gotten, that they haven't increased over that period of time. So a lot of that. So for the past year, certainly for 2025 and continuing into 2026, we're seeing a higher number of people coming to speak with us about their financial challenges.
Right. Is there a specific type of debt that you're commonly seeing when people are coming in, whether they're calling you or whether they're coming into your office? Like, what are you typically seeing?
Yeah, so it's sort of what we're finding is that, there's more lending opportunities out there, or more borrowing opportunities, I guess, from the debtor side. And as you sort of find, and for a lot of people, sometimes they have sort of maxed out their opportunities with their primary lender, usually a main bank, that kind of thing. And then when they can't get any further credit there, they're kind of going down the ladder. So they find themselves perhaps going to a finance company, going to, at times even the payday loan type companies, which are now offering longer term loans. It's just not payday loans as well. But the problem with a lot of that borrowing is that it comes with a very high interest rate, and it's sometimes very difficult to manage in addition to whatever else people have on their plate. But in moments of some desperation, sometimes people will take advantage of these kinds of borrowing opportunities that maybe in the long run don't do them a great service.
Yeah, and I think part of that as well too, and correct me if I'm wrong, is that I think Canadians really do their best on paying their mortgage. Like they'll let other things slide. And then it sounds like what you're saying is that they will then go to these, maybe get a second mortgage or, go easy or easy financial or whatever it may be. And all of a sudden now they're in these, high interest paying companies that really allow them to spiral out of control quite quickly.
Well, that's it. And I think one of the complaints I hear from a lot of people too is they've gotten to the point where they're sort of just barely keeping up with their payments every month, but the payments aren't really doing anything because they're only servicing the interest. So they're kind of looking down the road into the future and going like, I don't see how I'm ever going to get out of this because it's just all I'm doing is paying the interest, which is just consuming almost all of the payment that they're making. So that's a challenge for sure. But yeah, in terms of the kinds of debt we're seeing, certainly credit cards are still a big thing. There's still lots of credit card debt out there, and again, as well, fairly high interest rates as well with the credit cards. People have multiple cards. Sometimes, we people get drawn into that. Every time you go into, I don't know, Walmart or Canadian Tire, somebody's approaching you saying, "Hey, get our new card. It'll come with all these points that you can redeem for merchandise or whatever," right? And so people get drawn in on that. And a lot of times, if you're keeping up with your debt payments, your credit rating is going to look pretty good, and there's really no reason why you won't get turned down. But unfortunately, then that's another temptation, and we end up using that additional credit. And then after a while, it becomes a matter of people literally like moving debt around. They'll borrow from one source to pay another source, and it just kind of goes around in a circle. And eventually, they run out of headroom somewhere along the way, and then they have to look for some financial help.
Right. Yeah. So they're taking on a new credit card because it's maybe 0% interest for the first 3 months or the first 6 months. And so they start juggling and juggling. And all of a sudden, you can do that for a couple of years and then it spirals out of control quite quickly. Right. So,
That's it, exactly. Yeah, taking advantage of, and there's nothing wrong with taking advantage of some of those offers where, 6 months, no interest kind of thing, whatever, if you do a balance transfer. And that's okay. But I mean, at the end of the day, it is kind of just kicking the can down the road. You still have to have sort of a plan to address it and to reduce that amount of debt over time in some kind of strategic way. So, yeah.
right. Okay. So let's say now I've come to the conclusion that, look, I need to sit down and talk to you or somebody in your team. What's the cost? Is there a fee to it? Does it, are there a couple different meetings that we go through? How does that all work?
Sure. So, I mean, pretty much every licensed insolvency trustee out there, without exception, and certainly all of us that are here at MNP, we offer a free consultation up front at the beginning. We usually book about an hour to meet with the person and talk over the circumstances they find themselves in. And you know what? We look at all the options that people have. So, if we see a situation where, it looks like somebody can maybe refinance, if they have real property, they may be able to refinance to pay off unsecured debt that's at a high interest rate, or other ways of maybe consolidating debt, or maybe there's something they haven't thought about in terms of liquidating an asset they may have or whatever. If there's an option that doesn't require our involvement at a formal sort of level, that's fine. We're happy with that. We send them off in that direction to try those other things. And, if that doesn't work out for some reason, or those weren't options in the first place, then, definitely we can look then at, something like a consumer proposal, if that might help them to get on top of their debts. Or in the very worst cases where people unfortunately find themselves sometimes, then maybe a bankruptcy would be the right choice. But obviously we try to find an alternative to that as best we can.
Right. And now that you're touching on those two things, bankruptcy and consumer proposal, there's obviously a difference between both of them. Can you just explain the difference and what each one means?
Sure. So, when you have debt, I mean, among the various choices you have, one of which is to try to settle with your creditors yourself. So you can go to a creditor and say, "Look, I know I owe you this much money, but would you take 50 cents on the dollar or 75 cents on the dollar and call it a day?" And if they are willing to put that in writing and make that agreement with you, then great, you've settled the debt for a lower amount. But that's an informal way of doing it. You're kind of doing that yourself on a one-off basis with your creditors. If you have a lot of debt and it's a bit overwhelming, then you may want to look at something like a consumer proposal. Consumer proposal, in its simplest definition, is a settlement with your creditors. You're going to the creditors and saying, "Look, I can't pay all this debt as quickly as you'd like me to. However, I can make some payments. I am making money. I have some income that I can commit to this. Would you accept this much of an offer?" And a consumer proposal by law can only run as long as 5 years, which is 60 months of payments. And so you can make an offer to the creditor saying, "Look, I owe you, $30,000, but I can afford to pay 20,000 over the next 5 years. Would you guys accept that as a full settlement of the debt?" And if they vote in favor of it, if they vote yes for it, then you go ahead with that. And as the licensed insolvency trustee, we file the proposal with the federal government to make it official. Once that's been filed with the government, the creditors have to come to the table and negotiate and deal with it, fairly and openly. They can't try to do an end run around the person and sue them or anything like that. That does stop all legal action against the person. So it gives them that breathing space to sort of rejig their finances and figure out what they're going to do. If we need to, we'll negotiate with the creditors a bit if the initial proposal offer isn't strong enough from their point of view. But the important thing to remember too is that we don't need a unanimous vote from the creditors. We just need more than 50% of the debt voting yes. So that's something too that people can bear in mind, is that doesn't have to be a universal acceptance on the part of the creditors.
Right.
So that's kind of the short version of how a proposal works, and it can be a good way of people getting a handle on their debts and making a payment that's affordable for them in the longer run.
Is there
So
one that
yeah.
stays on your credit longer than the other?
Yeah, so the impact of the two things. So just to touch briefly on bankruptcy, if someone is in a position where they really can't make a settlement offer with their creditors and they're just completely tapped out, maybe they've had a significant life event where they've lost their job, or they've had an illness or an injury or something like that, then sometimes a bankruptcy might make more sense. They don't the amount they have to pay and maybe lower. The one thing to keep in mind with a bankruptcy versus a proposal: in a proposal, you're not giving up ownership or control of anything. You're simply making a settlement with your creditors. In a bankruptcy, technically, you're assigning what you own over to the trustee for your creditors. However, there are a lot of things that are exempt, things that you don't have to give up, but there may be some things that have to get sold and the money brought into the bankruptcy for the creditors. Now, in terms of how long it stays on your credit record, it's one of these, it kind of depends things. With a bankruptcy, though, sort of worst case scenario is that from the time you finish your bankruptcy, it could be on your record for up to 7 years. And that kind of depends on which of the two main credit reporting agencies we're talking about, but 7's sort of the worst case scenario. And then with a proposal, it stays on for 3 years from the time you finish the proposal. Now, if you run a full 5 years with a proposal, that could mean that you're looking at about 8 years in total. But you do have the option of paying the proposal off early if things go well, and so that would shorten the whole time frame that stays on your record. So there still can be some advantages to being in the proposal, and the rating in a proposal slightly better. It's still not great, but it's a settlement as opposed to a complete bankruptcy or uncollectible rating that you might otherwise get if you had to do a bankruptcy.
Right.
So.
So it really depends on where you are, how much debt you've got. Like I guess every situation is going to be different based on, what's happening in your life and whether or not you should go bankruptcy or consumer proposal. Now, you did mention something along the lines of that maybe not everything would get pulled into that bankruptcy. So what about your home? Like, how does that work if I'm living in my primary residence, or maybe if I've got rental properties? How does that work?
Mhm. Yeah, so it gets a little more complicated when you've got real property, involved. In Ontario, there is an exemption technically for real property. It was not really legislated in order to help people looking to, avail themselves of some sort of debt relief option. It was really more a matter of making sure that judgment creditors didn't try to seize a property unless they were sure there was some equity in it that they would be able to extract to pay the judgment that they got. So it's fair to say that in general, the any exemption that might be available in Ontario anyway doesn't really apply. So when we look at a real property, we look at, well, how much is it worth fair market value right now? And how much is the mortgage or mortgages on it in terms of the amount of encumbrance? And then in theory, if the property had to be sold, what sort of cost would be incurred. So normal real estate and legal fees, that kind of thing. Now, if we deduct all of those things from the fair market value of the property and there's something left over, in other words, what the person would get in theory handed to them by the lawyer if they sold the property, that's an asset of theirs that generally speaking isn't exempt. And so if you do a proposal, for example, you'd want to make sure your proposal is robust enough that it's going to compensate the creditors for that. So you get to keep the house. The house wouldn't be affected directly by the proposal, but we have to account for this when we're offering something to the creditors to say, hey, theoretically, guys, if this house were sold, this is how much money might be available to pay you. But in the proposal, we're offering this, and usually the proposal's a bit better because we try to sweeten the deal a little bit so that there's some incentive there for the creditors to vote in favor of it.
Now, what about if you've got a property, but it's in a corporation? How easy is that to find or to track down?
Yeah, so I mean, when people file either a bankruptcy or a proposal, there are standardized, I guess you'd call it statutory forms, things you're filling out and signing off on to say, this is my financial situation. This is my income, my expenses, my assets, my liabilities. And, people are obliged to be honest and say, hey, I'm a shareholder in a company. I have this 1, 2, 3, 4, 5, 6 Ontario Inc. And in that company, I have this rental property, and there's also a mortgage and this, that, and the other. And, so then our job as the licensed trustee is to look at the situation and go, well, okay, does this person's shares in the company have any value? When we look at the value of the real estate in the company and the amount of the encumbrances on it, mortgages, what have you, is there any difference there? And would there in fact be some kind of share value in the company if the company was liquidated and the assets sold and all the debts paid off? So, we do include that calculation in that comparison that we offer to the creditors because they're entitled to know that, yeah, technically you've got an asset in terms of your share value in the company you own. So that does come into play. And don't forget, with these documents too, people are signing off under oath. They're swearing that the information they're providing is true, correct, and complete to the best of their knowledge. Right. So, it better be, because if it's found out later that it isn't, they could be in some hot water because of that. So.
Okay. And hot water, I guess what, like maybe fees, fines, any jail time
Well, I mean,
potentially?
it is an offense,
Yeah,
in our system. It's perjury technically, right? When you
right.
lie on a form that you've sworn is true, so there could be court repercussions for that too. Maybe not necessarily jail, but there might be some sort of financial penalty for that. So, so it's a serious matter, and people are expected to be honest and truthful about their situation, and realistically, at least in my opinion, and obviously I maybe a little bit biased because of the work I do, but I think our system is pretty fair, pretty reasonable. You're expected to try to make good on the debts you've signed and said you were going to pay back. And if you need a break from your creditors, the law allows for it, and there's a mechanism there for that. So it's sort of trying to balance the needs of the creditors and the debtor, and that's kind of where we sit in the middle between the two to try to find that balance and find something that ultimately everybody can live with.
Right. While we're on the topic of homes or rental properties, what's the difference between, say, a power sale and a foreclosure? And is there one that we see more often, say, talking specifically in Ontario?
Yeah, so there's the difference between the two, and you're right. In Ontario, we see primarily the power of sale proceeding. And with power of sale, the main difference is with foreclosure, which you see a lot more in the U.S. in particular. But with foreclosure, the lender, the mortgage holder, is essentially saying, "Look, I'm gonna take this property and back in compensation for what I'm owed, and I'll sell it. I'll get whatever I get from it, and that's going to be basically be in full satisfaction of the debt that you have with me." And of course, you have to vacate the property, all that kind of stuff. You're not allowed to stay any longer, and away you go. The main difference between that and power of sale is power of sale allows the mortgage holder, the creditor, to sell the property. The property doesn't actually necessarily change hands. It's still technically in your name during that power of sale proceeding, but ultimately when it gets sold, of course, it gets sold, transferred to the new owner. But the big difference there is that if the mortgage holder cannot recover everything that you owe them on that mortgage, when they sell the property, then any shortfall you're technically still on the hook for. And that's definitely a big problem for a lot of people, particularly in a market where you have falling real estate values. And that's what we're seeing right now in Ontario a fair bit, is that versus a few years ago when we were in sort of the height of the pandemic and, people outbidding each other and all that kind of thing. Now we're in a real estate environment where there's actually a fair bit of real estate on the market, particularly in some markets around the country. And people are struggling. They're having a hard time selling their properties for what they hope to get for them. And in some cases, what they need to get for them just in order to come out clean. In other words, that they won't have a shortfall to the mortgage holders, right? And so that's becoming a bit of a challenge. And I actually have a few people that have been forced just by circumstance to kind of abandon their property, hand the keys over to the mortgage holder and say, "I'm sorry, I can't do this anymore. The costs are too high." And then the mortgage holder will sell the property. And in some cases, there is a shortfall to the mortgage holder. And then, they have the right to pursue the debtor for that money. And that sometimes is what drives them to come see us and talk about a possible solution.
Right. So foreclosure, essentially, the person who's in first mortgage or second position, they're actually now foreclosing on it and taking possession of that property, correct? And then
Right,
the power of
exactly.
sale, they're not, and they're actually just selling the property, or the owner of the property is selling it. Is that correct? Those are the
Yeah,
differences.
so I mean, there's still going to be the power of sale proceeding still allows them to have vacant possession, so you
Okay,
still got to
got it.
leave.
Right, right, right.
Once you stop making your mortgage payments, you're on borrowed time. You're only going to be able to stay there for so long. So the mortgage holder still has the right to vacant possession, because obviously if the mortgage holder is gonna hire a real estate agent to help them sell it and everything, they're going to want to maybe do some cleanup, some fix up, they're going to want to show the property, all that kind of stuff. So obviously they can't have the debtor still in there. They have to go, but it's just a different sort of legal proceeding fundamentally, in the sense that again, when they sell the property, that doesn't mean that their debt is fully satisfied. With the foreclosure proceeding, typically once they get the possession of the property, that's considered to be basically there's an equal sign between the property value and what the mortgage holder is owed, even though in reality that may not be the case, but they generally don't have the option then of pursuing the debtor for the difference if there is a difference.
Got
So
it. Okay. And then the other thing as well too is that when it is in power sale, you can't just sell it for whatever. Like, you actually have to also prove that you're trying to get the highest price possible to the previous owner.
that's right, exactly. So there is something that's in legal terms, which is called improvident realization, which is where somebody who's in a position of being able to sell a property, a mortgage holder or whomever, they just kind of dump it. They sell it for whatever, the first person that comes along and makes an offer, they're like, okay, well, that's not acceptable. You still you have an obligation to try to realize the best price you can on it in order to reduce the liability of the debtor for any shortfall. So otherwise, the debtor could turn around and sue the mortgage holder that sold the property and say, well, look, you can't hold me responsible for all this shortfall because you did a lousy job of selling it, basically, right? So, but the courts have weighed in on this a fair bit, and it doesn't have to be perfection. The mortgage holder does not have to show that they've canvassed every market, tried to find every single person they could to make an offer on it. They just have to show reasonability. And if they list it with a real estate agent and it's up on MLS and they list it for several months and they don't take the first offer and they try to, they make some efforts to try to get the best price, even though that price might not be what everybody hoped for, it's still considered to be a valid price that they got for it.
Right. Yeah. No, so it's a good point. It's not like how it used to be back in the 80s, at least from what I've heard anyways, where, it was like, you get some crazy deals and discounts, right? So that probably changed when, maybe like in the 90s or so, do you know?
Yeah, I think there. I don't remember exactly, but I know certainly we had another one of these situations in the early '90s where the property values, the bottom fell out of them, right? And
Mhm.
and so there was a lot of sort of property dumping that went on, and that's where I think that the courts weighed in on some of this stuff because there were accusations of improvident realization, and I think that the people the defense was, well, look, everybody's dumping property. I couldn't get any better than this, out of them, but I think that's probably when it started. There's more, but it's always been sort of a thing, and of course we saw after the sort of 2008 subprime debacle in the United States, where same thing, you were able to buy a nice place in Florida for $45,000 or something crazy like that, but I mean, literally back then the market had completely collapsed, so it wasn't that that people were selling for less than fair market value. That was fair market value, unfortunately, at the time. So.
Yeah, for sure. I read a report the other day where in Ontario, they're saying that insolvency is going up. And I think it's about 2 to 2.5% in 2025. What are your thoughts on that? And if I'm getting the numbers right, do you see any concerns? Are we heading down a path where you might think that we could be getting into something more difficult in the next couple of years?
Yeah, I mean, my sense of it is based on the trend is that we're going to be in for the next couple of years anyway. We're going to see higher numbers of people coming to see us. I think that's just a function of a number of things, not the least of which, as I touched on earlier, just inflation after the pandemic ended. There was just this sudden spike in inflation that not everybody has caught up with. Their incomes haven't kept pace with that. You only have to do a bit of grocery shopping to realize how much things have gone up in the last 5 or 6 years, right?
Yeah.
And then there's still a certain amount of interest rate implications there. We're not back down to where we were. And then honestly, I mean, what's happening south of the border has an impact on us, right? And so there are some folks that are directly affected by tariffs. There are other folks that it's sort of a bit of a domino effect. It may affect one area of the economy, and then that sort of spins off and affects other areas of the economy. And I think for the most part too, what I've noticed too is that for a lot of people, I think for the most part, Canadians are optimistic people. We're good that way. We have sort of a generally positive outlook. But with everything that's been going on, particularly given what's, the sort of adversarial relationship we seem to now have with the United States and all of that, people are feeling a little more pessimistic about their financial futures. And that in part drives their decision to go, you know what, I'm done. I can't do this anymore. So there is a psychological component to this, and what's happening in the economy and what people believe will happen has a big bearing on whether they decide to, move on and try to deal with their debt or hold on longer.
Yeah.
So
You know what? That's a really good segue into the second part of this conversation, which is like risk, trends, and the bigger picture. You're touching on tariffs, and obviously now we've got a war that's going on. So why don't we take a quick little break, and then I think we'll jump right back into that. I think that's a good conversation that I think a lot of people are going to want to know about. So we'll be back shortly. Thanks.
sounds good. Thanks.